Notes more than anything else that I have done, it is very much just a relationship game. So I am still dealing with people that I met back in 2010. We're still doing deals together because now we know and we like and we trust each other. And so we're able to do deals. And that can be a little bit daunting for somebody just getting started. And we're like, well, I don't know anybody. No, you don't. So there are a number of conferences. I took over a conference a couple of years ago. I highly recommend going to whatever note conference you can go to just to start meeting people and chatting it up and networking. That's really the name of the game.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
All right. Welcome back. This week's guest is Nathan Turner. He is the Canadian cowboy slinging paper. He is a note guy. So the Canadian note guy is what he goes by. I think we have a great conversation. We talk about notes, all things notes. So if you're interested in learning about investing in notes, buying notes, or creating notes, and then being able to sell those notes to somebody like Nathan, this is a great show for you. He goes through the process of how he started just by chance back in 2007, getting into the note game in the United States from Canada, and how he has morphed over time to where now he has a fund. So we talk about the fund, how he structured his fund, what they're raising, what they're targeting for return profile for their investors. All that is in this episode. So it's a fantastic conversation with him. You're going to get a lot out of it. Please go on, rate and review, and leave us a little bit of comments. It helps us out a ton. Bring on great guests just like Nathan. If you are looking for notes, he has a fund, and I also will give our fund a plug. It is the Ram Capital Fund. It's right here. You just go on there. You can invest direct and learn more about it. Please feel free to reach out to me directly, and I'm happy to chat with you about it. So let's jump into the show with Nathan. Here we go. Well, hey, Nathan, welcome to the show. It's awesome to have you on. I appreciate you spending some time with us today to share your knowledge about notes and investing. And I'm really looking forward to this conversation because we have something very similar going on. So I want to see how your operations are running and get some feedback and advice from you just in general. So again, welcome to the show, the Canadian note guy. Right on.
Yeah, no, absolute pleasure to be here. This is good.
Fantastic. So for those of us that don't know you, the listeners that don't know you, give us a quick rundown, how you got into real estate and the notes space specifically and why it's been appealing to you.
Yeah, sure. So Nathan Turner, the Canadian note guy, meaning I live in Canada. So everything I do is in the US, but I live in Canada. I like paying taxes. I don't know, but I'm here in Canada. I started doing real estate back in like 05, 06, back when everything was looking really rosy. I was doing fix and flip. And I really enjoyed doing that up in Canada. And I really enjoyed it. It was a lot of fun. Made some good money doing that. I got stuck with one property as the market started to change in 2007, and it just wasn't selling. So I did what you're supposed to do with real estate. Either you sell it or you rent it. So I rented it, and it didn't take long. I was like, why do people do this?
Yeah.
I don't get it. I liked the cash flow, but I didn't like anything else that went along with it. It was a headache. Cash flow is nice, but it wasn't a huge payment. It just seemed like more trouble than it was worth. So that was kind of my beginnings into real estate. And I was excited about it. I saw the opportunities, but I couldn't figure out that landlord thing. It just didn't make a lot of sense to me.
Was that the only one that you bought as a rental or kept as a rental?
Yeah, that was the only one. Yeah, baby. And I was like, I don't know, not for me. I get it in principle, but in practice, oh man, no, it was not working for me. So fast forward a little bit, I got contacted by a friend of mine, late 2008, right when everything was going all kinds of crazy. And he had run into these group of investors who had bought a portfolio of properties in like April 2007, right when the market was like at its peak. The deal was supposed to go, they were supposed to buy this portfolio, sell it out to another outfit, and that deal fell through. So fall of 2008, there's a bunch of guys in California. They had no real estate experience, didn't know what they were doing. It was supposed to be a quick deal.
Yeah.
And then they got stuck with all these properties in the Midwest that they had nothing, like no information. They didn't know anything about it. So they brought me and my friend on board, like a POA, power of attorney, and no operating budget, and do what you can.
Yeah.
That was kind of what we had. So we came up with this genius idea of starting to sell houses on terms. In Canada, that's very rare. That it's almost unheard of. So we honestly thought we'd invented it. We thought we'd invented seller financing. And then, of course, we didn't. As we went along and we started talking to other people, found out it's actually fairly common. And that was kind of my introduction into that. So we had been creating these notes, not knowing that's what they were called, not knowing what we were doing. But again, just as an opportunity, that's the way that we saw a way out of all these distressed properties that we now had charge over. That was the beginnings of that. So it kind of organic, just kind of sort of fell into it, really. The opportunity was right.
Yeah, that's fantastic. So did the guys buy a package of notes or did they, oh no, they bought the houses and you guys created the notes. Okay.
Yeah.
So how did you guys meet these people? Just real fast. We don't have to dwell on the 2008, but how did you guys even know them? How did they even find you to?
Honestly, it was not even me. It was my friend. He was from Canada. He'd moved down to California.
Okay.
And I don't know, just networking and
got it. Okay. No, I mean, I was like, that's early days social media. That's early day, like podcasting's not, so it's just interesting how you guys would have, met up in that time frame.
Yeah.
So do you still have any of those notes or did you guys exit that entire portfolio? What happened there?
Yeah, finished that off. So we were able to sell a couple of them just like wholesale, just to get a little bit of operating capital. But mostly we were just selling them like as is. And these were already distressed properties.
Yeah.
So the idea was own this home for less than rent. That was kind of our tagline.
Yeah.
So if you could pay rent for $500 in the neighborhood, we'll sell you this house for $400 a month.
Yeah.
All of the upkeep, all of the repairs that are needed, that's up to you. That's why we're giving you a discount so that you can afford to do these repairs.
Were you taking down payments at the time?
Yeah. I think we took like 2 months worth of regular payments.
500 down, 500 a month.
Seriously. Like it was, we were doing it all wrong. I'm the first to admit it. But
at the time, I don't know. That was what the going rate, because I started buying around that time in 2009 and I was picking up houses for $20,000, selling those things on terms at 60.
Yeah.
But I'd have a crew go in and just paint everything. It's like, I have this story, it's just comical at the time. I picked some guys up from Home Depot, went over there, gave them 5-gallon bucket of paint and said, paint this house, ran down the street to the next house, had another group of guys go paint this house, go back to the first house. The first house, they had painted like everything, the outlets, the windows, like everything, just painted everything.
Yeah.
But yeah, that was the type of property at that time. So I get it.
Yeah.
Well, that's interesting. So you have morphed. I mean, that's a ton of backstory on going from that to what you are doing now. So I have, I could ask you, like, how was the market change? What have you seen? Like, are you dealing with Dodd-Frank? Like is Dodd-Frank still going? Is that still
it is definitely still alive and kicking.
Still, okay. I didn't know if they had changed the terminology, but you're dealing with consumer laws compared to at the time, if you were selling those houses, you may have been selling them to investors who were looking to fix them up and you were basically doing hard money, but at very, very favorable terms. If that was the type of people or clientele you were selling to, I just didn't know how you guys had structured that. So tell me, I guess now, what does your operation look like now? And then we can kind of fill in the gaps and see how you got to where you are now. Yeah.
So the progression to now, we skip over the last 15 years or so. Now I have a fund, like a 506c fund.
Yeah.
Investors go into that. And then I go out and I buy performing notes. Mm-hmm. So typically these performing notes are seller finance. So it's kind of come full circle. Well, now I'm going back to the seller finance, the same thing that I was doing back when I first started. So now I'm buying those and just holding on to those performing notes. Yeah. Paying the investors their return. And then I get to keep whatever's left over on top of that. Yeah. All right. Good change. Yeah, for sure. So we'll dig into that. All right. So you progress then into you have your fund. I really want to talk about the return profile that you offer investors on the fund because part of the show, I'm talking to a bunch of agents who are making commissions and they need to invest the commissions to turn it into cash flow. Yeah. This is a very passive type of investment in the sense that, you're not going out fixing toilets and that sort of thing. Yeah. You are, if you have to foreclose, that's where your active comes in, right? Yeah. But for the investor side, the limited partners in your deal, curious on the return profile, how you guys have structured that thing. So why don't we chunk it up? We'll talk about how you developed this note buying process and why you started buying notes rather than creating notes. So what was the progression there and what clued you into just buying the notes rather than creating them? All right. So we were selling these properties on terms and we had this system of, getting the property and then selling that on term. Well, we already had the properties. Went from that, we started buying non-performing. There were a ton of non-performing notes back in the day. Yeah. And the pricing was ridiculous. Like we were getting 30 cents on the dollar easy. So again, coming from the real estate background, in my head, it was like, oh, that's an easy, fast way to get property. And what we would do, kind of the best case, easiest way that we would do that is we would target non-performing notes in Columbus, Ohio on vacant properties. But that was the kind of the ideal thing that we were looking for.
Yeah.
Reason being is if it was vacant, then we didn't have to go through a foreclosure typically. And we would just have to find the owner and I would offer them cash for keys. So a deed in lieu of foreclosure. If you give me the deed, we'll wipe out the loan and everybody's happy. Now I've got this property. Then I would go back to that original idea of selling them on terms. That's kind of how we started going. And we had a project going in Columbus for a few years. And it was actually, I think it was about 2013. And I had learned about Dodd-Frank and about these new laws that were coming in that was going to make it more challenging. And at the very least, there were regulations around what we were doing. So we're like, okay, that's fine. So we knew what we needed was a mortgage loan originator. And try as we could not find somebody. We'd go and talk to like mortgage brokers. We'd talk to banks. So we need this mortgage loan origination. Can you do that for us? Can we send you our files and you guys can review them and make sure they're compliant, blah, blah, blah. They're like, Dodd who? And I'm like, oh, man.
Yeah. Early days.
With what we had going on, it was good, but it wasn't great. And it was working, but it wasn't fantastic. So that combined with these new laws with Dodd-Frank that were coming in and knowing that there was a compliance that we just couldn't do, a compliance that we couldn't meet, we decided to shut that down, that part of it in the origination. And I went from that and just transitioned into buying these non-performers, ideally with the idea of getting occupied properties and then rehabbing the loan and just getting these notes performing again. Part of it was the realization that working with properties is much more difficult than just working with notes. As much as I can handle it these days, as much as we can ever kind of formulate it to work out the way we want it to, I would way rather own a note than a property, just because it's far less work. And that there's the whole question about appreciation versus depreciation, on and on and on. And I have gone around in my head so many times. And ultimately, I would rather not have the headaches. I would much rather just have a performing note that's paying me every month that I don't really have to do very much with versus a rental that, they call up and, oh, this needs to get fixed, that needs to get fixed. I have to set aside part of my monthly income to go towards those eventual repairs. Then I have to actually do them. And then I got just problems. So for me,
You're straight in the money allocation business now where you are managing the money. All right. So then let's talk a little bit about one thing you mentioned, deed in lieu. You were getting deed in lieus back in the day. And just out of curiosity, were you having issues with title when you're doing deed in lieu when you went to resell those properties? Because that's become a thing, or it was a thing, but I don't know if you were having issues at the time.
At the time, no. But one of the things we figured out pretty quick was do a title search before you offer the deed in lieu.
Yeah.
Because then you find out if there is anything outstanding.
Yeah.
It took once.
Yeah. Yeah.
Oh, shoot.
Yeah. There's still this thing.
You're like, there's still that thing that's out there.
Yeah. Yeah. Does not wipe it out. Okay. Just wanted to highlight that. Anybody going, if you've created a note yourself and you just offer a deed in lieu, make sure you clear that. Yeah. I mean, look at the taxes. Have they paid the taxes? All those things. The taxes aren't going to get wiped out regardless. If you take it back, you're going to have to pay those things. So there are other things that can stick to the property as well, unless you do an actual foreclosure. Okay.
Weird things, IRS liens. And we had one that was a Department of Justice lien, like weird stuff that I just don't want to get involved with. Yeah. So do that title search for sure.
Kind of curious. Some of the war stories. Maybe we'll get into that in a minute.
Yeah.
It's one of those funniest and worst things. You also mentioned rehab the loan. So walk through an example of that and what that looks like. So you take a property, take it from buying the note to rehabbing it and then getting it to performing again. What does that process look like?
Yeah. To me, that's one of the most fun things about a non-performer is when we can go and approach the homeowner and say, okay, look, you're not making payments. You haven't made payments for the last, 6, 9, 12 months, 18 months, whatever it's been. And say, okay, so I refer back to, did you ever hear Bill Bartman?
No.
He's passed away now, but he was a guy who had bought credit card debt back in the day.
Oh, maybe. Yeah. Okay.
Early 2000s, something like that. Anyway, I read his book because I was like, if he's collecting on unsecured debt and I'm collecting on secured, I got stuff to learn from him. So my favorite line in his book is he says he'll approach borrowers and say, the only thing we can't do is nothing. And I'm like, oh, I love that. That is perfect. So there's all kinds of things that we could do. The only thing that's not going to happen is nothing at all. Yeah. So with that in mind, what can we do? So you've got this, whatever, $2,000, $5,000 of arrears. How do we want to treat that, first of all? Well, first of all, where are you at today? Is this something that you can afford now? Are you back working again? Whatever it was that took you away from making payments in the first place. Has that been resolved? If so, what's the new affordable payment for you? And very often we're working off of what can you afford to pay in a month. So rather than getting into a conversation about interest rates that they often don't understand in the first place, it's about what can you afford in a month. So if your old payment was $800 a month, is that something that you can come back and do again? Or is it $600 a month? If it's $600 a month, here's what that means. We're going to stretch out your amortization period. You had 20 years. Now we're going to stretch that back out to 30 years again. That interest rate, we can adjust it one way or another, and that affects the payment, and we back into it that way.
Yeah.
So it's really, and then that arrears, we can go back to that and say, okay, you owe 5,000, you can pay 2,000 today. Fantastic. Let's do that. We'll add the other 3,000 back onto the loan. You can forgive part of it if you want to. I mean, tons and tons of flexibility, and whatever you and the borrower can agree on.
Okay. So I'm listening, and I am hearing you say you're buying these notes, it's non-performing or performing. And how are you able to just forgive money, Nathan? Like, how does that happen? If the note face value is $80,000 and you're just going to forgive some money, how is that possible?
I'm the bank. I can do whatever I want.
But I also imagine there's a discount component to it that
absolutely, yeah,
I'm driving at here.
Yeah.
So
yeah, I'm buying at a discount. So one of the cool things about that is my purchase price of the note is not public record.
Yeah.
So, you buy a property, and whatever you buy that house for, that becomes public information. The note is not, the pricing on it is not recorded anywhere. So I can buy it for whatever discount I can get it for. Nobody knows what my discount is. So if the face value is 80,000, maybe I bought it for 40.
Yeah.
So I've got tons of room in there to do all kinds of whatever I want. So if I want to forgive some, that's up to me. If I want to tack it back on the loan, that's fine too. And just lots and lots of flexibility.
Yeah. All right. So let's walk through an example of buying a note, kind of the process, what it looks like, and even start with, like, where are you finding these notes? How do you find notes to buy? And then how do you evaluate, and then go through the process of actually closing it? Where do you close? Like, let's walk through a process so that, again, if no one's ever bought a note, they can get that in-depth knowledge from me.
Sure. So if you've never bought a note, the first thing I would say is get some education. And that's not even a pitch. I don't teach, but if you want to learn, I've got some colleagues that can certainly educate you on that. But the thing that I had to get my head around getting into the note game is, this is not real estate. This is real estate related. The real estate is the collateral, but this is a finance game. So understand how finance works. With the property just happens to be the collateral in this case. Yeah. So that's the very, very first thing, is make sure you understand the difference and some of the rules that go along with that. Like we mentioned, Dodd-Frank, understand what Dodd-Frank is and how it works and what you need to comply with and how to do that. Like, all those things are really, really important, just to make sure that you understand that before you even get into it. That being said, once you've got some of that education, I would say notes, more than anything else that I have done, it is very much just a relationship game. So I am still dealing with people that I met back in 2010. We're still doing deals together because now we know and we like and we trust each other. And so we're able to do deals. So that can be a little bit daunting for somebody just getting started. And we're like, well, I don't know anybody. No, you don't. So there are a number of conferences. I took over a conference a couple of years ago. I highly recommend going to whatever note conference you can go to, just to start meeting people and chatting it up and networking. That's really the name of the game.
Okay.
I'll give you one freebie, I guess. Shout out to good friends of mine. Yeah, good friends of mine. They've got an online note platform, and it's called PaperStack.
Okay.
And that's PaperStack with no K. So stac.com. And they're great. They're out of Florida, really good guys. I've actually helped them develop some of their systems as they were getting to, like, contracts for deed. At first, they were just doing mortgages, and they're like, well, this contract for deed thing, that sounds cool. How do we do that? And so I was able to work with them and help get some of the processes done. Great guys. And they've got it really dialed in. So that's a lot of preamble that goes into that. Let's say now that you've identified a note for sale. Either that's from somebody you met at a conference that has a list, or somebody in your local market, we call it like a mom and pop investor who had one extra property, they sold it on terms. Now they're looking to cash out of it for whatever reason. Oh man, there's a number of things. So the real estate is your backup plan. So yes, we are concerned with what that real estate is, where it is, and how much it's worth. Other than that, I don't really care if it's got granite countertops or not. I don't care if it's got a new roof or not. That doesn't really make too much difference to me as long as the value is what the value is as is. I typically am not looking at an after repair value with some exception, but generally we're looking at like today's value, what's it worth? If I had to, and the question is, if I had to foreclose and take this property back, what could I resell it for in current condition? So that's kind of your first thing. Where it is matters more so in what state. So for example, New York has a terribly long foreclosure process. And again, I'm always kind of planning on the worst case scenario, which to me is taking back the property. If I need to foreclose on a property in New York because the person stopped paying, that can take me more than 2 years. And that's just a really long time. On the opposite end of that spectrum, Texas is a very fast foreclosure state. If you hit all your dates exactly right, you can get a foreclosure done in 2 months. I've never been that fortunate. The fastest I've done a foreclosure in Texas is 4, but it can be done and it's far faster than most other states. Let's see what else. I am looking at the note numbers. So what is the interest rate? What's the term? How long are they making payments for? What kind of down payment have they made? How much equity is there? And what's their payment stream look like? How long have they been making payments? Are they always on time? Are they sometimes late and make it up? Or what does that look like? So it's really, again, going back to that finance idea. And that's probably a whole class in itself
sure.
of how to kind of look at that and determine what's good, what's not good. Let's say that you've determined that it's good and you want to make an offer. Remember, we're not changing title in most cases, unless this is like a contract for deed. If this is just a regular mortgage or a deed of trust, there's no exchange of title when I buy a note because I'm not buying the property. I'm just buying the paper attached to the property. So that nothing changes for the borrower except where they're making their payments. I am making an offer to the seller. We agree on a price. Typically what happens is once that's all done, I will send them a wire for whatever the price is, and then they will send me the collateral file, which is that file folder full of copy of the, well, not a copy, but the original mortgage, any assignments that might be in there, anything and everything that has to do with the loan. That's what we're looking for in that file.
So you're not closing at a title company. Are you pulling title on these things?
I am pulling title as part of my research to make sure that there's nothing outstanding that may supersede my first lien.
Yeah. So you're out of state, out of country in Canada,
right?
And you're buying a note in Texas, and Jim Bob is selling his note, and he says, "Yeah, send me $100,000. You wire the money, and then you wait to get the file back."
Right. Now, hopefully, in this case, I have some kind of relationship with Jim Bob before I send him $100,000.
All right.
If it's just somebody you met off Facebook, I would be very cautious.
I get that. It's the whole reason title company exists, so that you have an exchange at a third party. Okay, so that's interesting. So,
and you can go through title.
Yeah. So you're typically just buying from vetted, people who have either just created a note or they have a tranche of notes or they have something they're selling as a package that you then can buy. Okay. Right. That's interesting. So you're in this process, you're going through, and so you've done your research, you're looking at the note. How are you determining, and I know this is a whole finance class, I know, but how are you determining your discount rate on future cash flow? And like, what are you looking at typically for a return profile for yourself?
Yeah.
Not worried about the fund or anything like that. Like, what's a deal, no deal, go, no go sort of thing for you? Hey everybody, Randal Declared here with a special shout out to our friends over at Envone. If you're looking to diversify your investment portfolio, you've got to go check them out. It's envone.com. It's a crowdfunding platform with a wide range of investment opportunities, things like real estate investing and even bourbon barrel investing. So check them out. Invone hosts our crowdfund. It's actually a single family real estate investment fund that we have launched with them. And we've had an awesome experience working with Levy and his team. They're super responsive, very quick to assist us with things that we need. And they have crowdfunding down to a science. Go ahead and check out episode 154, where Levy and I discuss crowdfunding in detail and how it can help you either invest or raise capital. And check this out. As a friend of the pod, launch your crowdfund with Invone, and you're going to get an exclusive 10% discount when you head over to invone.com/ABC, or simply call Levy and his team at 475-800-8716 and mention Agents Building Cashflow. Go crush it. Happy investing. Talk to you later.
Yeah. So one of the very first things I'll look at if somebody sends me a note is what's the current interest rate on the note? And if this is something that was originated in 2020 at 3%, I can pretty much tell you right off the bat, we're not going to get to a price that makes sense for the seller. Makes sense for me, but it won't make sense for the seller. So the reason being is I am looking for my target yield. So my target yield when I'm buying is at least 12%. So 12 or higher. And if it's written at a 3% interest rate, I'm going to have to discount my purchase price really low in order for me to get that kind of return. If that note was written at a 10% or 11%, my discount's going to be much, much smaller. That's going to be much easier for us to get a deal. So that's like the very first thing I look at. What's the interest rate?
Yeah. How about
so that would be like, my tip for anybody who's creating these or agents that are helping people sell on terms, don't try to compete with the bank. If the bank is offering 7, you're offering 9. Yeah. This is a specialty product and it demands a higher price.
Yeah. Okay. So I'm kind of curious on the seasoning. Like, what are you typically looking for? Are you buying newly minted loans, or are you waiting a year? The sweet spot used to be 12 months from memory, but what is it now?
Yeah. So seasoning is the number of payments that have been made on that note. And it's really a personal preference thing. A guy that I do a podcast with, he wants at least 3 months. For myself, if it has gone through qualifications with an RMLO, with a registered residential, whatever that R1 is, the mortgage loan originator, if it's gone through that whole process and it's been approved, I will buy that brand new.
Okay. At a higher discount, or what is?
Maybe a slightly higher discount.
There's some guys that I know in San Antonio that have been creating and packaging. I don't know if they were packaging, but they were getting maybe California investors who were just looking for a set return. Mm-hmm. And instead of them rehabbing the houses, they were going out, they'd buy these houses and they turn around, sell them on terms, but put the investor in the position of ownership of that note from day one, and they would simply cash out. So like, hey, the face value of the note is $150,000. Send that to me today, and this note's yours, basically. So they get 100% day one origination. And so I'm kind of curious, again, what are you typically paying? Is it just yield based? I originated a note yesterday, and I can get a 12% return on your money by offering a 3% discount on the face value of my note. You're going to buy it?
Yeah. Essentially. If it's a brand new one, I might want more like a 12.5 or 13.
Okay.
Yield, just because there's slightly more risk there.
Yeah.
But
it's still yield based. Yeah. Not okay. All right. That's good to know. Yeah. Okay. So you go through the process, and then just the paperwork that we were talking about. Does the deed of trust get updated?
The deed of trust does not. Anything that's being transferred is just with an assignment. So it's an assignment of mortgage or assignment of the note or assignment of the deed of trust in that case. Yeah. Okay.
So can you explain what is a launch to the note?
And is that the launch essentially is like signing the back of a check. It's your endorsement.
Yeah.
Saying, yes, I agree that I'm selling this. So to me, it's actually redundant, but sure.
You still get them. Yeah.
And I find it really interesting. The assignment tends to be a little bit of a longer document, typically 1 or 2 pages. And it's a notarized document, and it gets recorded at the county. And a launch can be 1 paragraph.
Yeah.
No notary, and it's not recorded, but it needs to be part of the file.
Yeah. Yeah.
And if you go and do a foreclosure, depending on the judge and depending on the state, that allonge is absolutely essential.
Yeah.
So make sure it's in the file.
Yeah. Yeah. Okay. So I just want to make sure, like, the document package that you need to close one of these things out, it is, a launch. It's an assignment. And is there anything else that you have to have in there? The original note you want?
I need the original.
Yeah.
What I like to have in there is if there's any application form from the borrower.
Yeah.
I would love to have that just for the information that I can get off of that, including like where they work and things like that.
Yeah.
It's nice information to have.
Yeah. Okay. All right. So that's how you buy a note, folks. Just do that.
Yeah.
It's the calculation. I love looking at the calculations and originating the notes myself. I look at that same thing. I mean, you can get 28, 30 something % returns on some of these deals. Some of the notes that I originally created, I was buying properties for 20, putting 5 or 6,000 into it, having everything painted in the whole house, that sort of thing. And then I'd sell those for 60. So when you double what you have in the deal, I mean, your returns look really good on selling on notes. So
if you have a channel where you're able to acquire property at a low enough discount, that works all day long. And that is, I think, the current challenge. And I could
for sure.
Wrong, but
No, it is. And so buying the notes that have already been originated and getting them at a discount, you can still hit those returns. So is your 12%, let's talk about returns in general, right? So for what you're looking for and what your fund is structured to do. So you have a 506C, so that means accredited only, and you can advertise, you can talk about it, do all the things.
Right.
And we've talked about funds at length on the show. So if you haven't heard those, go back and search some of the shows, and I talk about them, and we have fund managers on, all kinds of stuff. So we won't dive into that right now, but how have you structured your fund, and what does that look like? How much have you raised? What are you looking to raise? Do you raise on an as needed basis for deals? Is it open-ended, closed? Give me all the details so that I get an idea.
Yeah, sure. So ours currently it's set up as a 5-year term. So closed-ended fund, we are raising 5 million. We're still at the beginning stages of that. We're still less than $1 million. So we're open and actively looking for new investors. We pay 8% with quarterly distributions and minimum 50,000, maximum 1 million. That's kind of the basics of that. Yeah.
Okay. So it's an 8, just straight 8 pref is how you structured it?
Straight 8 pref. Yeah.
Okay.
I figured this is your sleep at night money. If you want to go and gamble and potentially higher returns sometime in the future, fantastic. And you should do that. But this is the safe portion that you set aside that you know that you're going to continue to receive.
Yeah, right on. I mean, so we've got a crowd fund. It's very similar. It's 5 million is a max that you raise. We're sub 1 million raised right now, and we are buying the properties in order to put them in. But I love the idea of actually buying the notes. And that's definitely something that we have in our terms, that we can actually go out and just acquire the notes. Seems cleaner, seems faster if you can find them, right? It's just
and
like
that's the challenge.
You have deal flow. And so again, that's why I'm wondering how you are coming upon these notes. If you're getting, like, again, back in the day, I would get these tapes of deals. Is that still a thing? Is that still happening and you're seeing that, or it's just
to some extent?
Yeah.
Yeah. There's still tapes being sent around, but not like it was back in the day. Way back when, I mean, I had a Google spreadsheet for every month, and I would have somewhere between like 12 and 15 different tapes every month that I can go through. And on those tapes would be anywhere from like 50 to 300 per tape. So I mean, there's immense availability, and those were all non-performing. These days, non-performing, much less so. They're still out there, but much less so, which I guess is good news for the economy, but not so great news for non-performing note investors.
Yeah. I mean, it was a lot of cheap money, 3%, right? People refinancing, getting that sort of thing. So, okay. I guess tell me more on the idea of the fund. Like, why did you start going towards a fund model? Have you done one in the past, or was this your first one?
This is my first fund. I've been doing notes for a long time, but the first fund. A few different reasons. On the investor side, it's far more predictable and far more, I guess you would call it safe, where you know with great accuracy when you're getting paid and how much you're getting paid.
Yeah.
Versus on the and specifically with the non-performers back in the day when we were just doing, buying them up and then splitting profits, which is great. However, when's that note going to turn around, and for how much? The variability was huge. So all in all, yes, we did well with that, but just a different kind of investor at that point, somebody who's much more risk averse. So that's been a big shift, is going after different kinds of investors, people that are just looking for that passive income, who, busy professionals, people that have income but no time. And that's what we're looking for. On my side, it's organizational wise. I mean, it's far better. We had over 20 investors, and because we're not a fund, everything had to be kept separate. So I had, 23, I think, different sets of reports that I had to do every quarter, and keeping that all separate and with the accounting and everything, like it was a
Yeah,
massive task.
for sure.
So that, has become much more simple and much more streamlined.
Yeah.
And yeah, I think I'm just at a point now where that's kind of what I'm after, is just easier, more streamlined, simple is good.
Yeah, for sure. Are you seeding the fund with some of the notes you currently have, or is it all new deals that you're looking to do?
We've got a few that are coming from that old portfolio, some of the performing notes that we're just kind of shuffling over into the fund model because they're already there. It's easy.
Yeah.
And then we know borrowers, we know how they pay, all that kind of thing. And so that makes it pretty easy. So that's been nice. But then, yeah, a lot of new notes. So you're talking about like, how do you find them? And that really, going to conferences, that has been the secret sauce, is just going out and talking to people and networking and just seeing who's doing what, and who's got stuff for sale.
Yeah, got it. So when you're going through again with a fund model, are you targeting again just the yield spread, or are you saying, look, we're going to be in these deals at, it's hard to say LTV because again, like
Yeah.
is the main thing the yield? That's really the main thing. And if you have to take it back, you have to take it back. And okay.
So the main thing is the yield. Kind of a close second is, instead of a loan to value, it's a investment to value.
Yeah.
I want to make sure there's at least a 25% spread there. So
Okay.
if we do need to take it back, we've got a 25%, gap with it, that we have to work with. So that works really well.
Okay. So the total portfolio value is going to be what is that? $6.5, $7 million, 7.2 or something like that.
Yeah, about that. Yeah.
Yeah. Okay. So once it's all fully deployed, that you'll be sitting on. So then how does Nathan exit in 5 years? Because you have the same thing I'm looking at, right? You've got principal and interest pay down, and you have fixed 8% that you're paying back. And so at some point, those things are going to cross. Right. It's not for a long time, but at the same time, you want to exit that because your equity upside is kind of tied up in that deal. So how do you exit a 7.2 portfolio all at one time, or do you slowly start selling off individual notes? And are you getting hit with a discount when you sell to someone else who's looking for those notes?
So the kind of the wind down is that last year. And that we're actually looking at changing this over to an evergreen, which we'll see. And that changes things up a little bit. But the current plan is, that last year we start selling off. And the idea is I want to be buying out of 12, 13, 14, so that when I'm reselling, and I'll also want longer term notes. So 25, 30-year notes. Yeah. So that principal balance hasn't moved much.
Yeah.
So when I'm reselling, year 4 to 5, then I'm reselling at like a 10 or 11% yield off to somebody else so that I can get all that capital back. Yep. I'm not really looking for an upside. I'm just looking for getting that capital back out.
Yeah.
Ideally, I'm buying as many as I can into my own portfolio so that I can that's my retirement.
Yeah. I got it. Okay. So you're going to exit by taking out your investors, essentially.
Yeah.
Yeah. It's kind of a similar thing we looked at as far as pay off half the portfolio on an exit and then own, $5 million worth of notes free and clear sort of deal is the idea. So how are you, like with the prior portfolio, the other deals with these 23 investors, like how many notes do you have that you're managing at any given time? And then what are you looking to get to with another 5 million to deploy?
Yeah, we had a little over 3 million with the previous investors, and we had 100, I think at our peak, 105 maybe.
Notes.
105 notes. Okay. We're almost done with those. We've got about 30 left, and then ramping up the fund. Once that's fully deployed and fully funded, right around 100 notes.
Yeah.
So that's the idea.
Yeah. Okay. And so how do you service those? Like, what are you doing? Is that in-house or do you have a third party? What are you doing?
No, a third party.
Yeah.
Yeah. Third party servicer. Again, for anybody who's looking to sell a note, if you can get that with a third party servicer first, it's, I guess, like a level of credibility. I can look at your spreadsheet and I'm not saying you're a liar, but how do I know for sure that that's exactly accurate? I would rather go with a third party servicer that really has no dog in the fight, and they can tell me exactly what has happened and what hasn't happened from a third party standpoint.
Yeah. So do you have any recommendations on, because we use like FCI out of California.
Mhm.
We've used some other ones locally, but do you have a recommendation?
There's lots of them out there. I'm using Madison Management out of
Okay.
Jersey.
Yeah.
Texas guy that I met just about a little over a year ago, who I really like. The company is called Provident Living. Shoot, I'm going to get that wrong, but if you just search Provident Living
Note
Servicing
servicer.
or
Yeah,
something
yeah.
like that.
Okay.
But Sohail Bedroon, and the guy's just awesome. So I really like him. He's only in a couple of states, so I can't use him for much right now.
Mhm.
But he is expanding and growing, and as he continues to get into other states, I'm happy to move all my stuff with him.
Nice. Okay. Well, that's a good plug. We'll put contact info in the show notes, or a link to his stuff as well.
Yeah.
Well, look, wealth of knowledge, man. I appreciate you jumping on and just,
Yeah.
talking about your business and what you're working on. I guess the last thing, maybe this would be a good way to leave it. Like, what
Sure.
are some of the tools that you are using just on a day-to-day basis in order to manage this process, right? CRMs and whatnot, but
Yeah.
other tools just to even value notes, is it, because I can do it on financial calculator pretty quickly, but I imagine you have a little bit more sophisticated tools that you might be using. So,
Yeah. Okay. So CRM, I use Pipedrive,
okay.
and that's really, really useful. It's very customizable. So it's not built for notes, but nothing is really.
Yeah.
There's a couple of them out there, but I haven't really given them a shot yet. But Pipedrive works really well. One of the things I like about it is that it syncs in real time with my Gmail. So
Okay.
anything that goes in and out of my Gmail goes right in and out of Pipedrive in
Okay.
real time. It's not like I have to go and update it to get the new batch of emails or whatever. So I really like that. And it's a good place to keep notes and comments of, whatever communication I've had with realtors, with lawyers, with borrowers, whatever.
Yep.
So that's a good one. Evaluating the notes, I mostly just use my financial calculator.
Yeah. I mean, I legit use my cell phone. There's an app on my phone. It's like, I mean, it's pretty quick and easy.
Yeah, it's on my phone, it's on my computer, it's on my laptop. So that's mostly what I'm using. I've got a friend who's a spreadsheet nerd, and so he's created this like massive spreadsheet, and he's trying to convert me to that.
Yeah.
And there are certain things that he can do on there that it's pretty cool, I'll admit. But I don't know. It's a level of complication that I'm not sure I'm ready for.
Nathan, I love it, man. You're like, I need simplicity. I want it to be simple and, quick and not, don't overcomplicate it.
Yeah.
It's funny.
That's kind of
Have you looked at like Mortgage Office? I mean, I know that's like a very detailed, you can service, you can do all kinds of stuff. And I think that's like what FCI and a lot of servicers use.
Yeah. I looked at it a few years ago, but like this was 5 or 7 years ago.
Yeah.
And back then to buy it was like $10,000 something like that.
Yeah. I mean, I looked at it too back then and I was like, wait a second. But, if you're standing up a servicing company, I think that makes more sense.
Yeah.
Yeah. But okay. So you don't use anything that detailed or complicated to just take what you guys are working on.
No, I'll keep all my notes in Pipedrive between that and the servicing notes that I get from the servicer. That's good.
Yeah.
That's all the information I need.
Solid. Well, again, man, I love talking notes. Again, we're working on something very similar. So I'm going to definitely stay in touch with you, see how you guys are coming along with things. If you're looking to invest, Nathan's got a fund. It's out there. I'm sure you can go to the link in the show notes, direct to Nathan and find out more information about the fund. Is it stylized as Earnest Living LP? Is that the fund?
Earnest Investing. EarnestInvesting.com.
Yeah.
One shameless plug. Talked about the conference, but I didn't actually name it. So it's the Diversified Mortgage Expo. The next one's coming up in May, and we're in Nashville. That's what we do.
May 25?
May 2025,
Yep.
May 2nd and 3rd.
Awesome. Yeah. All right. Well, yeah, there you go. You heard it. Probably not here first, but it's coming up in May. Again, Nathan, man, it's awesome talking with you. I appreciate you sharing your knowledge about the note industry and what you're working on right now. Again, if you're looking to find out more information, reach out to him directly, and we'll catch you guys on the next episode.
Thank you.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.